The old saying goes, good things come to those who wait. But does waiting yield more attractive valuations for your portfolio? And could that value come from investment-grade corporates? We're going to get into that story right now on UBS Trending. Hi, everyone, and thank you for joining us. I'm Anthony Pastore. Welcome to another episode of UBS Trending. My guest in the studio today is Erin Spalsbury, Head of Investment Grade Credit at Insight Investments. Erin, nice to have you in the studio.
Thank you for having me.
Good timing having you here for obvious reasons. For all of our people who have been watching, by now we know the Fed's direction. They cut rates at the recent meeting. They expect another 150 basis points of cuts. So there's a lot of questions out there about what's going to be happening down the road, particularly on the bond market. And something that we're looking at, and you're talking about as well, are credit spreads. They're very historically tight. We're seeing the de-inversion of the yield curve, where 2 years are finally lower than the 10-year counterparts. But I want to take a step back. Let's talk about how we got here and what you see now in the credit environment and where we are today. How did we get here?
Well, three things. One, we do know that maybe credit spreads are a little bit tight compared to where they have been, but importantly, yields are still pretty high, okay? And quite frankly, what we're seeing is pretty strong corporate fundamentals, which may justify tighter credit spreads at this point in the cycle. Now, that's not necessarily where we're actually seeing any credit problems. In fact, you really need to look at the consumer to see where there may be some cracks right now in the cycle.
Yeah, talk about those because, as you mentioned, credit spreads. Give us an example of what that looks like to somebody who may not really be as familiar with that part of the market.
Sure. Well, generally speaking, credit spreads have a negative correlation with interest rates. So if you see interest rates come down, sometimes you see a little bit of credit spread widening, and normally that's derived because when rates come down, that's usually in reaction to more negative growth in the economy. Now, in this case, we have pretty strong growth, so we don't actually expect credit spreads to widen. But even if they do a little bit, you have such high yields right now that you can still have pretty strong positive returns as the rate cycle continues and rates come down.
Right. What's fascinating about, we're still sitting here, and I guess economically speaking, we're expecting a soft landing. That's what our chief investment office expects. But the economy, relatively speaking, is still on pretty decent footing, and the Fed obviously had a big decision to make. But when you think about the soft landing, how do you think that is going to play out? Because traditionally, when we're looking at duration, right? So 10-year, treasuries right now are about 375. Go further out the curve, but that 30-year is not that different, or historically hasn't been that different for the last 2 years. But there may be more opportunity now, given where the Fed is going. So talk about the soft landing and what the expectations are.
Sure. Well, I think you need to kind of look at where the problems might be, okay, to see where the soft landing really actually can occur. So right now, when we kind of look at the consumer, we say, okay, we're seeing some delinquencies rise. And the way you like to think of it is if you had a recent grad, they just come out of school, they've got student loan debt, they have auto loans, they might have some credit card debts, and quite frankly, their rents are pretty high because we've been through a period of pretty high inflation. Now, that person may start to get a little delinquent on some of those auto payments or credit card payments, and quite frankly, they're looking at the housing market going, I'm never going to be able to afford a house in my life, so I'm going to go live at home with my mom. Now, let's talk about the parents. The parents probably have a mortgage from back before 2022, so a very low rate mortgage. Maybe they're letting their credit card balances go up a little bit because they feel pretty financially secure with those low mortgage payments. But at the same time, inflation has gone up, so maybe they're pulling back a little bit at this point, going, I've been working through my savings, it's coming down, and I'm a little concerned. But quite frankly, the Fed has started cutting, and that will filter into those interest rates that are on those auto loans and credit card loans. And you may actually see mortgages come down over the next year. In fact, you should, with rates expected to be cut about 200 basis points. So maybe that housing market will open up, You'll get some of those younger people into homes, and that can result in more spending. And quite frankly, that would be the soft landing that the Fed is looking for. You see consumers, continuing to spend and growth on kind of a nice low trajectory.
Right. I mean, yeah, the consumer, when you look at what happened since the pandemic, obviously there was a whole increase in their savings because people weren't spending money on vacations or going out to dinner, and that's starting to deplete. And now, of course, we're looking at consumer confidence maybe starting to decline a little bit. But at the same time, as you pointed out, rates could potentially come down for those 30-year fixed mortgage rates. And I think something like 90% of people who are currently in their home have a mortgage that's below 4%. So it's really not very tempting to sell your house unless you have to go, unless if you're going to get another mortgage. So hopefully the inventories will start to open up a little bit more for these younger people who are looking to buy that home, especially if rates are coming down.
Yes, mortgage rates should be coming down, and that in itself should make the houses a little more affordable.
Yeah, exactly. Yeah. So just give us a sense of for example, allocations to high quality fixed income, especially we're looking at investment grade corporates, some of the highest rated on, that anybody could put in their portfolio. Tell us a little bit more about what you recommend for an allocation in a portfolio.
Sure. Well, first, we're looking at credit spreads right now, and we're saying, you know what, there's been historical times when it's looked like this before. We look at 2003 to 2007, we had very high all-in yields. Credit spreads were a little low, and during that entire time frame, credit actually outperformed. Okay, now we know that didn't end very well in 2008, but what we can say is we're not really concerned about that at this point because we've gone through a pretty big regulatory change. Okay, so with banks a little more regulated, we're not as concerned. We can also say that when growth gets to about 1% to 2%, that's actually a sweet spot for US IG credit, because when you have higher growth than that, money tends to get diverted to equity markets. And when growth is lower than that, it gets diverted towards more risk-free assets. So 1% to 2%, very good for credit spreads. And quite frankly, because we do have these high yields, you can earn good coupon, nice payments, and have a little capital appreciation on top.
Right. It's essentially a Goldilocks scenario from what you're describing. Right. You don't want to go too far out. And what about duration? Where do you see, what's the best part of the curve right now in your estimation of opportunities in the credit market?
Well, quite frankly, all kinds of investors will have different duration needs, but when you look at credit, that's about a 6 to 7 year duration. That's going to be attractive, especially with rates coming down.
Right. Yeah. And you don't want to go too far out the curve to like a 25 or 30 years.
No, you tend to have a different set of investors there, more institutional.
Right.
That's more for pension accounts or insurance accounts. When you're talking about retail, usually it's kind of in between the 5 to 10 year, looks pretty good. And you definitely want to move out the curve because short-term rates are definitely going down a lot faster than sort of that middle of the curve.
Right, exactly. So that seems like that's where the investment opportunity sits right in here, that kind of 5-10 year sweet spot.
Yes.
Yeah, excellent. What about concerns about the election? Because everyone's talking about, obviously there's a lot of uncertainty around it. It's a 50-50 race going in, just a couple of weeks left. Does that concern you, or should it concern bond investors?
Well, I think everybody is a little concerned that there may be a little volatility around there.
Right.
Now, we've looked at this, and in the past, we actually have been able to discern any kind of pattern of more volatile spread behavior around elections in election years versus non-election years, okay? But what definitely does impact the fixed income performance is what the Fed does. So the Fed has cut 50 basis points, expecting another 50 this year and then 100 next year. And what we can say is, as they're leading up to a Fed cut, we definitely see positive performance in fixed income markets. But then if we look 2 years past the first Fed cut, we also see additional positive performance. So there's a step upwards in terms of performance. You've got plenty of time, if you haven't started investing now, to go ahead and invest in fixed income.
Right. I mean, it seems like because of everything you're talking about, it's a little bit more of a risk-on environment. So there are opportunities out there, which is really good to hear, especially for investors who maybe say, oh, I might be late to the game. But there isn't really, you're not late. You can get in now.
Sure. And what you should remember is, when it comes to investment grade fixed income, that's not a very strong risk-on view, okay? That is, I want to earn a little more yield. I want to earn a lot more income. And I want to have some protection against what riskier assets are doing. So it's good to have that allocation in your portfolio over time.
Great. Erin, thank you so much for joining us. Great conversation. Like I said, we'll have to have you back in a couple of months to see where we are as the Fed continues to do its job and give us a little bit more of an accommodative policy. So thanks for joining us.
Thank you.
Great. Erin Spalsbury again from Insight Investments. And thank you all for joining us. There's a lot more information on everything we talked about on our Insights website at ubs.com/views. Plus, you can also follow us on all the social media platforms, including LinkedIn, Facebook, and Twitter. You can also check out our Instagram channel at UBS Trending. Lots of great studios content that you're not going to find anywhere else. And as always, if you have any questions about what Erin and I spoke about today, make sure you're chatting with your financial advisor. Until next time, I'm Anthony Pastore. Thanks for joining us, everybody. And don't forget to keep your eyes on what's trending. We'll see you soon.